Hey everybody. So it is a wild day on the markets. We are up in a big way, over 4% in the S&P, over 5.5% in the NASDAQ. What does it mean? What's driving it? Well, this video seeks to provide a bit of insight on that. And the big thing that's driving the market right now is a less hot than expected read of the consumer price index. Now, what is the consumer price index? Why does it matter? Well, the consumer price index is an index, basically a tool where economists have aggregated the cost of different goods that consumers buy, and they do that on a month over month basis. What that effectively allows them to do when everything is rolled up and kind of weighted based on consumption behavior is that you arrive at a decent sense of how inflation is moving. Are the prices of goods going up? Are they going down? And what we got today was a less hot than expected read. So, what was the read? Well, it was estimated it would come in at 7.9%. It actually came in at 7.7%. Why is that such a big deal? That's still pretty darn high. Well, for starters, CPI is something that the Fed looks at, but more importantly, they look at core CPI. Okay, so that basically pulls out the cost of food, the cost of energy, because Fed doesn't really control for that. The Fed recognizes that people are going to eat, people are going to go places, irrespective of what they're doing with their federal funds rate. The federal funds rate is the rate at which they lend money to banks, who then lend money to consumers like you and me and businesses. And that's important because as you think about the core CPI, okay, so as we think about this, you've got the CPI read, right? And it came in at a significantly lower than expected level of 7.7%. What was estimated was 7.9. Now, okay, great. That's better than expected. Why such a crazy move in markets when that does not seem to be all that significantly lower of a value? And on top of that, it's still pretty darn high. Good question. So, for starters, let's go ahead and recognize that CPI is not something that the Fed pays as much attention to as core CPI. Core CPI is where you've stripped out the impacts of food, stripped out the impacts of energy. Why do they strip it out, or why do they not care? Because they recognize that people are going to eat, people are going to go places, irrespective of what the interest rate is in the market. The interest rate in the market is going to be more impactful on more discretionary spending, right? So those are the items that are included in the core CPI. And the core CPI went up a relatively lower amount, 6.3%, significantly lower than the 6.5% that was expected. Okay, great. Again, still pretty high though, like encouraging to see that core CPI has lower than expected. But again, still just by 0.2. Why does this really matter? Again, like, why are we seeing such a huge move? Well, the important thing to remember is that the Fed's goal is price stability, okay? Which is to say that people in a market need to have confidence that the price that they're paying today is the price that is reasonably going to be paid tomorrow, right? As you think about the housing market, for instance, a lot of people over the last few years have been making decisions based on certain expectations that the price is going to be higher. And that basically drives them to be making sometimes bad financial decisions. The Fed doesn't want this. The Fed wants a good, efficiently operating market. To see how that plays out, think about it. If you're a buyer and you're thinking that the price of a house is going to be way higher in a year than it is today, well, you better buy, right? And you better not miss out on this opportunity to buy. And maybe you're going to go ahead and waive contingencies or earnest money or all kinds of different concessions so that you get the house. We've heard a lot of the stories about that exactly happening. Reciprocally, on the seller side, you may not be willing to sell because you're so concerned that, hey, if I sell today and things are going to be much more valuable next year or even next month, I'm missing out on a lot of money. This is particularly exacerbated when the interest rates are low and people got a hold of their home for very low prices, and so or very little money down, more importantly, so that those gains are leveraged gains. So again, the Fed's goal here is price stability. And that is where month over month figures really comes into play. As we can see here with the CPI month over month, it's up 0.4. Again, they don't care as much about this particular number. What they really care about is this number, 0.3%. So 0.3% is a big deal. As you can see above, like we've been tracking it over 7% in our CPI figure and our core over 6%. That's no good. The Fed wants to get to a 2% level for price increases on a year over year basis. Obviously, we're not going to be anywhere close. We're not going to be anywhere close for a while because there's been a steady run up to reach that 6.3 value. But looking forward, you can kind of recognize that the month over month increase you'd like to see in prices is on the order of 0.1 to 0.2%. We're kind of getting close when we've got 0.3, especially when we were expecting 0.5. So this is a really, really positive sign that the Fed has an important indicator from the market to start slowing down the tightening cycle, to stop raising rates and let the market continue forward as it was before, and not basically continue to tighten policy, raise rates higher and higher. So again, taking that number as an input, okay, well, why then again does the stock market go up so much? Well, it's because the stock market is a forward-looking instrument and it is approximating future earnings from companies. When you think about a lot of the kind of less profitable companies out there, or especially unprofitable companies, the raising rate environment is like kryptonite to them, right? Because if you're not making money, that means you need to raise money. If you need to raise money, the challenge is a lot higher, because if you go to a bank and you're not making money and the interest rate is higher, good luck getting a loan. And then conversely, if you want to go to venture capitalists or the broader stock market for investment, people are going to be looking at investing in you and saying, how far is it till you run out of money again? Is this an extremely risky investment? And moreover, the money that you're going to make, I need to basically discount the value of whatever future earnings when you get to profitability to the present day. And if it's going to be a high rate environment where I could have been making a steady 5%, let's say, year after year after year before you make money at some point way in the future, well, my willingness to invest in you is significantly lower than it was when the interest rate was closer to 0%, right? And I could have had that same money parked in completely riskless assets and gotten virtually no return. So that's why you're seeing a big rally in, for starters, things like the ARK Innovation portfolio, which has quite a few unprofitable companies in it, first and foremost. Then you've got the NASDAQ, which is certainly much more growth and tech-centric. And then still big moves in the S&P and Dow, because those are, again, filled with stocks. Anything that's an equity sees some benefit from this. On balance, what does it mean to you? Let's just continue to keep in mind that it is still a high rate environment. So a lot of the things that I just said a few moments ago about raising money to support unprofitable operations, those still exist today, right? The interest rate is going to be somewhere on the order approaching 5%, might be a little bit less, might end up a little bit more. At the end of the day, that's still a challenging environment if you're an unprofitable company. So that's just a bit of a caveat, not to get too excited that we're going back to the days gone by. if anything, this might actually signal that if we're heading into a recession, it may not be as deep of one because the Fed has kind of managed to start putting a tamper down on inflation without necessarily getting so high as to truly crush the economy. But these things happen on a lag. So with that as all as context, that's why the market's raising today. If you got some good insight out of this video, I hope you'll like and subscribe it by pressing the little button. And thanks for watching.